who would have thought that insurance would be such a sexy topic?
And they're like, do you know Sean Mooney? And I said, I do. And they're like, is that who you're working with? I'm like, it is. They're like, now I really don't want to talk to you.
If I wasn't wholly committed of getting out of this deal,
I'm like, oh my gosh.
Completely.
I said, I talked to my client. I'm like, I'm so sorry. I can't believe I suggested this.
Sean Mooney? No, Shane Mooney Insurance.
There's 2 E's at the end. It's not EY. Welcome to the podcast dedicated to real estate, insurance, and building your business. Join us as we take you along our own business building journeys with additional wisdom from our network of local and national experts. Welcome to Bricks and Risk. Hey everyone, welcome to another episode of Bricks and Risk. I'm Tim Garrity.
And I'm Sean Mooney.
What's up, man?
How we doing?
Good. And before we get into it today, we're going to read another review from one of our fans.
One of our acclaimed listeners?
Yes. And if you're watching and or listening, you can actually write in reviews if you go to Apple Podcasts. Other places a little bit harder. So I'm going to read it. So this is from Gump215.
Gump?
You got
215.
That?
Sounds like a very bright man.
Sounds
like
almost made up.
Like an intellectual type.
So it says, listening into the first few podcasts, and I'm laughing a ton, but learning a lot. Great listen for anyone trying to grow their business or influence. Might be focused on real estate and insurance, but relevant perspective for any industry. Get an iPhone, Sean. Sincerely, Gump215. Yes, unfortunately, it's true.
Oh, he did write that.
All right, what are we getting into today?
Did I say best listener? I meant worst listener.
I love it.
Today's episode is brought to you by, I don't know.
Obey.
And La Colombe.
Yo, Obey, if you're watching and or listening, this guy's a walking billboard for you.
Once or twice, I think.
Just a few times.
Today's episode, we are going to go heels in on a duo topic.
Nice. I love this.
So what we're going to talk about is insurance and real estate.
Okay.
And both markets and how they're intersecting specifically around the topic of investments and building portfolios and kind of how the two are going to play off of each other.
This is awesome, man.
Yeah.
Cool. This is probably one of our first episodes where we're literally taking both of our respective industries. We found a really great topic and we're trying to meld them together so that people can learn a little bit about both. And I love this one because it really focuses on real estate investors in the US and how insurance is starting to affect their portfolio. Not only that, this is for people looking to buy real estate today. When you purchase real estate, again, we're always running numbers. At least I'm helping investor clients run numbers. Most of the time they're running their own numbers. And insurance is going to be a line item because when they look at their carrying costs for whatever they're looking to buy, insurance is part of it. And I will say I'm guilty of this, that when I do closing cost estimates, whether they're investor client or buyer, I just throw in a rough number, $150, $200 a month for insurance. And that's not the case these days.
Don't do that. Make it an exercise or a practice. If you don't want to reach out to someone and you don't want to do the legwork because you don't want to either step on someone else's toes or for whatever reason, have your client do the diligence beforehand.
Okay.
Because you don't want that surprise where it's, oh, Tim, you have a line item here for $1,200 a year, and it winds up being, $2,850 a year.
Right.
I mean, and what we're seeing now is like years ago, you could come to me with a property, and tell me where it's at, tell me what the purchase price is, and a couple other items, and I would get you into a real tight circle of where that's going to land.
Right, and what the amount is.
Right. Now it's like, it could be in between this and it can be in between
now
this.
That scale based on those little details of the deal itself, the home, let's call it. 'Cause this is more, we're talking about residential homes here. We're not really even talking about huge apartment buildings.
That's where it gets even more dramatic.
While that's being affected, let's focus on this survey, which there was a recent survey through Resi Club, which focuses on U.S. housing data, and Ground Floor, which is an investor syndication platform. This is people looking to like invest smaller amounts of money in bigger projects all throughout the country, and they want to make returns on it.
So like getting a real estate exposure for anyone.
Like if you've ever heard of Fundrise, it's basically like, hey, I got $3,000, $10,000. I want to put it into Fundrise or Ground Floor. I want to be part of a development or a building or a project that pays me returns every year.
Yep.
So in the survey, it said 80% of investors are concerned about home insurance increases. This is like 8 out of 10 that were surveyed say, while maybe it was 1 or 2 out of 10, let's say 2 years ago, 8 out of 10 now say they're concerned about the increases from insurance affecting their residential investment.
Yeah.
Like, that's insane.
And that's a national number. And I even looked at it the other day and I was looking at it. The Northeast is like the most dramatic.
So on top of the 80% of investors being concerned about home insurance increases, 37% said they're very concerned about insurance increases. Let me just put a scenario out there from my perspective.
Yeah.
We're doing the duo John here. So from my perspective, let's say I have an investor client and let's just say they're a family, they own a home in and around Philadelphia, and they're like, I want to go buy a rental property. I have $50,000, $100,000. I just want to go invest it in something where it's a good investment to own the property. I make some cash flow from the rent. I get a tax write-off. Maybe, maybe not. Hire a property manager. Those are really the people we're talking about here. So like normally if someone's looking at like, I don't know, let's call it like a $400,000 property, I might say, hey, normally like $200 a month for your homeowner's insurance. But now what I would probably do before or while we're looking at things that they like, I'd probably just have them call you. Say, do me a favor, run this address by Sean because I want Sean to give us an accurate quote for this particular property in this particular area. Because there's lots of things that are going to play into it to understand if 200 is a fair number or if it's too low.
Yeah. And what we're seeing now is everything changes, right? Like these increases are one part of the puzzle, but obviously the appetite for some of these carriers is also changing.
Yeah.
So like we had, I was helping Evan Siegel.
Yeah. What's up, Ev?
With a risk this morning that he came to me and it was like the 11th hour and he was like, this bank wants this and this insurance company's not giving them that. And, it's like a fight, like a standoff. And so that really wouldn't have happened years ago.
Yeah.
So it's just the environment of where things are now and pricing is one, but also underwriting, right? So like, a lot of times too is some people will just write the account and not care about what's happening on the back end.
Mm-hmm. That's crazy. So the deal that you were looking at through Evan at Siegel Financial, great company if you're looking for financing on a commercial property or business.
And help. Like he is
he's great.
Just a wealth of knowledge and knows so much because he's been doing it so long. Just a great person to have a conversation with.
Was that more like business insurance or was it for like a building itself?
It was an investment property.
Wow.
Residential. 4 units.
Okay. Yeah, but that's considered technically, I think it's like 5 or less is considered like residential, and anything above that, you're getting into more commercial.
Yeah.
Financing. Depends.
Yep.
Interesting.
And so, and then I also got my eyes on like, what was, what they were trying to do to go to the table. And I was like shocked. I was like, oh, this is, the coverage and the premium and everything. So it like, even from my position, it's like, I see things that I'm like, whoa, like, take me back a little bit in terms of where the market is right now.
Dude, I got a good story too. So I have a client right now, first-time home buyer. He's looking in Conshohocken, if you're not from Pennsylvania.
Dylan, how do you spell that?
Yeah, you know how to spell Conshohocken for us? Or do you call it Conchi as well with 2 E's?
I think it's I usually just do Conshohocken.
Go to the Google machine. We stumped them.
I love it. Well, listen. So I have a client looking in Conshohocken.
Yep.
We've looked at a number of properties now, and he made his first offer on a property. Was sitting on the market for a little bit overpriced based on condition. That's our opinion. We put the offer together, and we have, the offer was a little under asking, but he had all his contingencies. Most of the time, even years ago, 5, 10, 15 years ago, I would put property insurance and flood insurance as one of the elected contingencies in every agreement. No one really ever cared because they're just going to go get a homeowner's. It's like automatic.
Yeah.
So we put this offer in. It's got home, termite, radon, and insurance. And then the agent gets back to me.
Hey, wait, can you explain that? Just take it one step further.
Yeah.
For people out there that are like, well, what's the contingency and how would that play into the execution of the deal?
Yeah, so like if you buy a house, you can say, I'll pay cash and have no contingencies. It means like you're just going to buy it and you have no way out of the contract. But a lot of people, when they buy houses, they have mortgages that they need to get. So if they don't get the mortgage, that's a contingency they can get out.
And so when it comes to insurance
is part of what's called due diligence inspections contingency. And in that instance, they get the opportunity to research the condition of the home, termite, radon, and also research, hey, what's the homeowner's insurance going to be like on this property? Whether they're going to live there, it's investment property, it doesn't matter. So we submit this offer.
Yeah.
Insurance is part of it. I get a call back from the agent, and she says to me, we're not even going to counter. And I'm like, okay, is it because we're under asking? She's like, well, yeah, you're a little bit lower than where we want to be, but we don't like all these contingencies, namely insurance. I'm like, get out of here. It's kind of like what I said. She's like, no, that's a little bit of a risk. What if you guys go ahead and get an insurance quote and it's twice as high than you think it's going to be? And then your client pulls out because of that. No, we don't want to see.
So that's pretty subjective. So insurance contingency, it's not defined as like, can you get insurance or can you not get insurance?
If they don't like the quote, they can get out. Like if I said it's $200 and they get a quote from you and it's like, for whatever reason, it's $400.
Yeah.
Condition of the home, whatever it is, then they can say, I don't want to buy this house anymore. It's $200 more than I thought.
I can see how that's interpreted.
Yeah.
Right. Because it is an escape hatch that if you do want to get out of the deal.
Yeah. It's good for us. It's bad for the seller.
Yeah. And especially because if you're buying it as an investment property, you really have a calculation of what the rents are.
Exactly.
What the repairs are going to be, what the insurance is going to cost you. And if that changes for whatever reason, you can be out. I mean, I can understand from an investor's point of view why that would be.
Yeah. And it's in 15 years.
Never been an issue?
Never come up.
Yeah.
Never. And first time was just like, I think it was the package of what we offered. Sure. They were just like, okay, it's only been on the market like a week and a half. We're going to give it more time. Going to have an open house. I'm going to see if anyone else is interested.
Yeah.
But the last time I checked, it wasn't sold. And we're just patiently waiting for the second conversation. And when I talked to my client, I said, hey, you can get an insurance quote now if you want on that property. Just understand what it is. Yeah. And then if they come back to us, it doesn't need to be contingent because you already know.
You waived it,
So I threw that out there and we just said, let's just sit back. Let's go look at some more stuff.
Yeah.
But isn't that interesting? First time in 15 years, someone said, namely insurance. We don't like that.
And who would have thought that insurance would be such a sexy topic?
And they're like, do you know Sean Mooney? And I said, I do. And they're like, is that who you're working with? I'm like, it is. They're like, now I really don't want to talk to you.
If I wasn't wholly committed of getting out of this deal,
I'm like, oh my gosh.
Completely.
I talked to my client. I'm like, I'm so sorry. I can't believe I suggested this.
Sean Mooney? No, Shane Mooney Insurance.
There's 2 E's at the end. It's not EY.
E-E?
Hey everyone, this is Tim. your favorite Bricks and Risk co-hosts. But don't tell Sean. I hope you're enjoying this episode, and I'll get right back to it in a moment. Our audience grows through word of mouth, so if you would please take a moment of your time and give us a review on the platform you're on, that would be fantastic. Please also help spread the BNR word by sharing your favorite episode with a friend. We greatly appreciate your time and trust. Now, back to the show. All right, let's go to the next part of this. Was also in the survey and some of the stats they were talking about the average increases for U.S. home insurance premiums. I think this is really on single families they're talking about. So the whole country, what's the average insurance has gone up? And remember, we did a past episode, I don't know if it's out yet, where we were talking about, you're like, hey, insurance always goes up in some way, shape, or form. Like
yeah.
A couple points.
Moderate.
2 points, 5 points, whatever. Like depending
Single
on the
digits.
year. Okay, so this is interesting. So in 2019, it was 2.5% was the increase.
Yeah.
So again, probably pretty normal. Historical averages, it's probably gonna be something close to that.
Prior to COVID.
Yeah. In 2022, 6.6% was the increase across the US. 2023, 11% is the average. Meaning, like you said, some people, their insurance might not even go up at all. And maybe they're just low risk and they're just like, just leave it. Maybe it goes up 1 or 2 points. But some people are going up 20%. Like you had said before in a previous episode, like
I'm telling you,
that's nuts.
So if you look at that number and you think that 11% number is high, which it is.
Yep.
Wait until 24 comes through, because in this period for the last couple of years, 2024 is by far the largest that we've seen.
That's crazy.
I mean, I'm telling you.
You think it's going to be, what do you think it's going to be in 2024? So if they were dropping stats, what would you predict if you
over or under? If it was 15%, I would take the over.
Wow.
Yeah.
So you think it might be 15, 20% maybe?
Yeah.
So it's even going to be like almost double, possibly, that number.
Yeah. I mean, it's, and I could probably pull some recent statistics that would show like that trend line.
Yep.
And they do like Q1 for this year, Q2.
Bar graph or, whatever, you're just kind of like looking at line graph.
Yeah. And because I mean, I see it every day. And, nationally is broad brush increases. So where I think we are is, not as bad as Florida, California, and, Oklahoma and those types.
Yeah.
But comparatively speaking, I think that we're seeing some of the heavier increases when you're looking at it. We see 30, 40, 50%. 30, 40, 50% on homeowners.
My gosh, it's crazy.
Yeah.
All right, let me ask you this. I'm not going to put you on the spot too much, but
go ahead.
I kind of am. If you had to predict when insurance companies are going to start feeling a little bit better about where they are with like inflation, with like the weather risk, all these things we talked about before in the insurance episode. If you haven't seen it, it's fantastic. Watch on YouTube, listen on Spotify, Apple, or Amazon. When would you think this might kind of settle down? Like if you had to predict, again, you don't know, you don't have a crystal ball, but if you had to predict.
If I was Nostradamus,
yes,
or Karnak, I would say that it's probably going to be into the second quarter of 2025.
Okay. So you think there's an end in sight?
I do.
And you think at that point they'll either stabilize or be like, now we can kind of retreat back a little bit. Maybe it's not 15, 20%.
No, I think it's going to plateau. Gotcha. I don't think there's going to be much of a retreat.
Oh, so you just think it'll stop going
cool off. Yeah.
And then they'll figure out.
So what's been happening over the last year or two is they've been taking rate. So the premiums are up, right? And before, I think they were artificially under where they should have been.
Yep.
Like you know where
exactly
homeowners rates should be. So when you see some carriers that are, $500,000 home for like $800, like they're not making money on that, right? But they try to sell, thousands of policies and, just make the numbers work.
Yep.
in addition to the rate increases, they're getting very selective on who they're going to write. Like their appetites have changed, right? So that's kind of a component of why it's allowing these companies to get more profitable, right?
Mm-hmm.
And that's the goal, is to like get more profitable.
Stop losing like they have been.
Yep. And then in addition to that is they're getting very strict on like inspections of homes.
Yep.
Saying before we didn't really care, and if there was a loss, we're good. Like now it's like, I'm telling you, so like if you say 2019 and you issued 20 policies, you might have had like 1 or 2 policies that would have had a follow-up recommendation or requirement. Steps, railings, windows, roof, sidewalk, stuff like that, where they're looking at a property and they're saying, this could be the potential for a claim down the road.
Right.
From an insurance perspective.
Piece of sidewalks raised a little bit. They're like, someone could trip, someone could sue you.
Yep. And so 20 policies issued, 2 or 3 that might have recommendations requirement.
Okay.
Now, 15 homes out of 20.
Wow.
You need to do this. You need to do that. And it's funny because I see around my neighborhood even a house that will sell.
Yep.
And then shortly thereafter getting worked on.
Oh, wow.
So I'm like, I know.
Someone dinged them.
Yep. The insurance company's like, hey, if we're going to continue on this risk, you need to do X, Y, and Z. You need to like get the shingles repaired. You need to cut back the trees on the tree line. They don't want trees hanging over the houses.
Gosh.
So we literally driving around, I can tell you that I've seen it firsthand. I said, that house sold. They did an inspection and now they're requiring this work to be done, and it has to be done quick. So in the state of Pennsylvania, the Department of Insurance requires, if you want off of a risk, if you issue coverage and you say, we want off this, there's a window of 60 days to be off that risk. And it's a 30-day window of notification to the client. So you issue coverage June 1st. Mm-hmm. You got to inspect it in 2 weeks so that you can have the letter out in 4 weeks so you can be off of this risk in 8 weeks.
Wow.
It's literally ba-boom, ba-boom, ba-boom.
That's crazy.
And trying to get a contractor out there to do all this stuff.
Everyone's busy still. Or labor's tight. There's just too much demand.
So yes, prices are there, and prices are dramatically impacting the rates on insurance. But it's also these insurance companies saying, hey, we're not going to just look past that potential risk, that hazard at the house. If we can try to avoid a risk that we see is coming, we're going to go and do that.
Hey, Dill, do you currently have car insurance?
No, I don't even have a license.
No license. No.
I was going to ask you a question, but we're just going to go on to the next one from there.
Let's wing it. Let's go to Dylan and ask Dylan.
I was going to say, if you have car insurance, has your car insurance gone up?
Well, no. My car insurance has been pretty consistent. Yeah. No, my parents were always very, straightforward about like, hey, if you got your license and you're driving our cars, you're paying for insurance.
Nice.
And
those are good folks right there.
Yeah. So I kind of, absolutely. Much respect to that, like ideal. But
must be from Glenn's side or something.
Could be.
Must be something in the water.
9038.
Good parenting.
Yeah.
But I saved up my money and I ended up moving to the city anyway. So I
don't need it.
I just never got it. I don't know.
Wow. Interesting. Cool. Thanks, man.
I'm going to have him clip up. There's a recent study that it was looking at CPI, Consumer Price Index.
Yep.
And they kind of indexed all of the inflationary impacts for what people deal with day to day.
Yep. Like groceries and, everything else.
Yeah. And so it was a recent study, and on the bottom, stuff was actually going down maybe 2, 3, 4%.
Yeah.
And then you'd have groceries, rent, new car, used car, and everything was in the realm of -4 to like +4 or 5.
Okay.
So that was like
So it's like neutral.
Yeah. At the very top, Dylan, we're going to put this in.
It says Mooney Insurance Brokers with your face like this.
With an arrow going up and up.
With your hand just going like this.
22% year over year auto insurance increase nationally.
Damn. That's crazy.
And so it's like a bar graph so you can see it. So it's like a little bit like this. And then you hit the auto insurance and it's like.
Does it? All right, here's a good question. Does it matter if you own the car versus like lease the car? Doesn't matter.
Cost to insure.
Yeah,
Nope.
yeah. Gotcha.
Now the bank might require different things. So if you lease the car, the bank's going to have a different requirement than a finance company.
Yep.
But
Got it.
you're not talking much difference there.
All right, so let's, if we're talking about the survey, we're talking about the increases, everything that's going on right now with insurance, that's having a direct correlation to real estate, namely investing. And the reason it's so important to investing is when you buy an investment property, you have cash flow. It's like,
You gotta
hey,
run the numbers.
If I pay X and my principal, interest, taxes, insurance, and vacancy rate and my upkeep on the property is Y, like I need to make Z. Like I want to make a couple $100 a month in order to buy this property.
It's different than a home as your primary. You might get into a primary home and say, I love this home. I'm going to be here for 30 years.
There's an
I don't
emotional
care.
attachment. It's got a different function.
Yeah.
Investment properties are about money, dollars and cents, and numbers. So what's interesting is why this is a problem is investors who own single family homes are really starting to experience this.
Yeah.
Not necessarily, I'm sure the large apartment buildings have already experienced this, but now it's like the person who owns like 1 or 2 rentals, like let's say in Philadelphia, and let's say they only had $150, $200 a month in cash flow.
Well, it's like Keon. Remember Keon was on our show talking
$200
about
a month.
Single family residences that he, was cash flowing. These increases, this insurance component is a dramatic impact with what we're seeing, and especially hitting those types of investors that own these, 10 single family homes.
Yeah, that's crazy.
It's dramatic.
Yeah, and then that could be eating into his profits. So that's one thing to consider. Again, if you bought an investment property, let's say in the last 2, maybe 3 years, your numbers are probably going to be pretty tight.
Yeah.
Reason being, more so in the last year and a half, because interest rates have gone up.
Yep.
Because prices have been rising so dramatically over the last few years. So think about that person that bought the property a year ago. And if they're an investor, maybe they're sitting on a 7.5%, 8% interest rate on that property. And maybe they only have $100 or $200 a month in cash flow. And their insurance is going up 20% plus a month. They're like, wow, this is, and then the HVAC goes, or the dishwasher, or again, they got to fix something on the exterior. Now they're really digging in to their profits, and that's a problem.
Here's what I would say, because we have one investor that owns 50 homes.
Okay.
And that portfolio,
that's a good client.
That portfolio is just blown out of the water. It's 50 home, 50 increases, 10% here, 15% here. And the question is how do you manage it, right? Do you just take 15% on the chin? What do you do? And my approach with these clients is, number one, try to tighten up your properties as best you can.
Yeah.
Be proactive where and when you can to bring everything up to snuff. Because as this goes on, carriers are going to be very selective who they're going to give out their preferred rates to. Mm-hmm. And when you are demonstrating that you care for these properties, you have the proper upkeep on these properties, you're telling the carrier that a claim is going to be less likely with me because I'm doing all of these things to try and prevent a claim down the road.
It's proactive versus reactive, which you've talked about before. And again, you advising client, you don't have to do anything, Mr. and Mrs. Investor. You don't have to do a thing to your 50 properties.
Yeah.
But you might want to consider looking at all of them a little bit more detailed, understanding what's going on in the market. Again, if you're improving your properties, you're probably improving them for years to come.
Yeah.
So that's a smart investment. Normally, a lot of repairs and upkeep, again, usually they're tax write-offs. I mean, I'm not an accountant, so it's not like you're just taking the money and throwing it away. You're investing in your properties to potentially stabilize your insurance and or maybe have it go down.
Yep.
And what's also interesting is like, let's say that client of yours who owns the 50 properties. I know a lot of people that own big portfolios like that, and a lot of times they just lease things on their own. And how do you lease on your own? They put a sign up for lease. They go to Craigslist. They're like 123 Main Street, pay me rent, don't care about credit.
I think QAura has part of their site has rental listing.
I love this. But with those particular clients, those are clients that I love to talk to if I'm not working with already, because I can look at your 50 property portfolio and say, what do you get on every property?
Yeah.
And they might say, hey, I'm getting $1,200 on this one. I'm like, you should be getting $1,500.
Yeah.
I haven't re-rented it in like 7 years.
Yeah.
So that's something just like you're advising them on, like, take a look at these properties, maybe fix up some things that you think are a risk.
If you're charging more rent, take that additional rent and put it back into the property. Right. And then the other thing that we're recommending for our clients is take a high deductible.
Yep.
There's carriers and policies and people that come to us. And it's like, I have this investment property and I'm like, why do you have a $500 deductible?
Right.
Right?
Yeah.
Like,
increase it.
If you're an investor, you obviously have people that you can go to fix things.
Yep.
Right. So take a high deductible, $2,500, $5,000 deductible.
Yeah.
Because number one, if it's small, you don't want that claim anyway. And number two is, again, you're showing the carrier that you're willing
to pay $2,500, $5,000 if something goes wrong and not put in a claim.
Now you're speaking their language.
Yeah.
The insurance is here for
that's really good advice.
Catastrophic loss, right? There's a fire. The insurance company is going to pay that claim. And, the insurance company doesn't want to pay for your hot water heater was 20 years old and it leaked all over the floor because you didn't take the proper initiative to get that changed out when it should have been.
Yeah.
They don't want to pay that claim. They're going to sting you for it. And they're going to want to get rid of you as a client.
Yeah.
Take the high deductible, be proactive about the work in your home and your investment properties, and it's going to pay dividends down the road.
Awesome. Such great advice. Well, that's all we have for this episode, folks. So thank you for tuning in again to another episode of Bricks and Risk. See you soon. Thank you for joining us on another episode of Bricks and Risk. Our goal is that you walk away with 1 or 2 valuable nuggets, and we greatly appreciate you sharing your time with us today. You can find all BNR episodes on Spotify, Apple Music, YouTube, and anywhere else you get your podcast content. Until next time, keep learning and keep growing.